All right, well, we'll go ahead and get started here. So again, my name is Alex Oliver. I'm with First National Corporation, and I'm a financial advisor. I work with a set of families managing their financial plans. And we're doing our second installment of this year's financial boot camp with Schwartz and Schwartz accountants. Every year during the tax season, we try to put a few on just to give you some more insight about a holistic financial plan. And for this installment, we're talking about socially responsible investments, which has become very popular, especially in the last couple of years. This was one that I sort of inserted into our schedule this year as a bit of a personal interest. Very fun to go down this rabbit hole and see how this space has evolved. When you looked at socially responsible investments maybe 10 years ago, very common for those types of fees to be very high and not necessarily something I would recommend investing in. But as time has gone on, fees have come down. The amount of choices that you have in this space have expanded exponentially as demand has also risen for these. So I'm excited to go through this presentation and give you some perspective. A lot of my clients that I work with, again, I'm creating their financial plans to get them to retirement, help them save for their kids' college education. But after that, I do hear a lot more about wanting to take a little bit more of an active stance in their investments from this perspective. And I hope I give you some different perspectives on just how broad this space is, because again, as the years have gone on, we've gone from being very simple and very broad to being very focused and very specific and very niche. So should be very exciting. I'm sure you'll learn something because I've learned some things just creating this presentation. So I'm excited to get started here. Just again, as a quick background, my firm, First National Corporation, we're a registered investment advisor on the South Shore. We have two sides to our practice: the wealth management side, where again, right now we're working with a little over 400 families and $500 million in assets, and then a dedicated retirement practice side, where we work with a little over 50 401k plans and around 20 or 30 simple IRAs, managing the assets for their practices and their employees. And we serve as the fiduciary in both cases. Fiduciary meaning that we are acting in their best interest and doing the research for those investments involved, which is important to understand. I'm going to get into some rules around socially responsible investing that actually a little bit different on the wealth management side as opposed to the 401k side. So again, give you some perspective as we go along here. Just as a quick schedule, we've already done the investment vision for 2021. That was a couple of weeks ago. You can find that on the schwartzaccountants.com/events website with all other previous recordings. Today, again, socially responsible investments. A little over a month from now, we'll do a webinar about budgeting for primary and vacation homes in a financial plan. Again, another thing that I've been asked a lot about in the last year due to COVID, as more people have thought about leaving the city. And then finally, the first million is the hardest, how envisioning the long term helps you today. A great webinar for us to do a comprehensive financial plan and give you some vision on how that looks. So again, schwartzaccountants.com/events. This web page has actually been reformatted since I did these screenshots, so I'll have to update this next time. But again, if you go to the website, a wonderful list of webinars, and it's all categorized into the kinds of webinars you might be looking for. So plenty of good YouTube watching for you if you have nothing to do on your lunch and you want to learn a little bit more about finance. So before we get started, as always, make sure you consult your own advisor or conduct your own due diligence before making any financial decisions. Consider anything I talk about today as entertainment, definitely not advice, because everybody's financial plan is a little bit different, and there's going to be some associated risks with changing your investments as opposed to just using low-cost index funds. So just make sure that you're talking with somebody before taking anything I talk about and implementing it into your own accounts. So again, let's start broad here, and I have a lot to get to that I want to talk about, but just want to really emphasize how much more of a topic socially responsible investments, or ESG investments, if you will, are becoming part of the norm. This is just showing you the growth of ESG assets in ETFs. Now, ETFs have grown in general over the last few years, but this, as you can see, is almost exponential growth into people putting money into these kinds of funds. And when we say ESG ETF assets, these are ETFs that, through their own prospectus, through their own menu of how they're going to invest, they've mandated themselves that they're going to take into account these sort of factors. And maybe even more mind-boggling for me when I saw this was that out of all the assets that are professionally managed in the United States, as of 2018, about 26% of those assets were in some sort of, again, ESG mandated account or mutual or fund, I should say. Whereas in 2025, as the total amount of assets grows into, again, the trillions of dollars, they're actually projecting that about 50% of all assets will have some sort of ESG mandate amongst them, which I found to be pretty phenomenal. You know, there's a lot of money that's managed here in the United States, but for that high of a percentage to be into the ESG space is quite a projection. I was pretty surprised by that. But again, we'll help you to understand as we go along here that ESG investing is no longer something that is just kind of put off to the side and asked in a very, small amount of cases. It's something that most fund companies are implementing into their menu. Now, I think when we think about what is ESG investing or socially responsible investing, very common for people to know that things around the environment would be considered part of socially responsible investing. So this top one here, decarbonization of the economy, businesses that benefit from long-term climate trends, including electric vehicles, grid infrastructure, aluminum bottles, and then renewables like solar and wind. At least for my clients' portfolios, that's where I see a lot of interest. I get more questions about either proactively investing in those kinds of companies or trying to exclude oil companies, for example, from their investments. But I want to make sure I acknowledge that it's much more broad than that. So we've got 4 other categories here. Innovative medicine. So this would be helping to improve patient outcomes, increase access, and address high unmet medical need. I don't get a lot of questions about that, but that certainly does exist. Companies with diverse talent. So that's forward-thinking companies in areas like technology and finance, where top talent and culture are critical to long-term success. So we've seen a lot of push for that in the news, hiring more women, hiring more minorities, for example. And now there are actually ETFs that specifically cater to that. I'm going to give you a couple of examples of those ETFs as we go along this presentation. Sustainable housing and clean buildings, similar to our first one, but certainly different categories. Again, there's a lot of different industries in this world beyond, again, just solar and wind. And then precision agriculture. This one I really have to admit I don't know a whole lot about. I couldn't even find many ETFs that invest in these kinds of companies, but agriculture systems that utilize machine learning and next generation hardware to increase yield and reduce waste. So, very interesting. Right off the bat, you should know that socially responsible investing can be defined as many different things. And so you'll have a lot of different choices as we go along here. Now, how do we actually go ahead and make our investments? Now, again, what you're probably very familiar with and where there is currently the most amount of assets is this negative or exclusionary screening. So again, I've definitely gotten questions about maybe I want to have a large cap blend fund or something that's similar to the S&P 500, but I do want to exclude, let's just say, gun companies or tobacco companies. That is pretty common. And again, as you can see here, has the most amount of assets and still is growing at about a 31% rate. ESG integration, also pretty common. This is our second most amount of assets. ESG integration is not necessarily going to completely exclude those companies, but with an ESG integration, they're definitely going to change their weightings of their underlying holdings to be more toward what they deem as a more ESG friendly kind of a company. So I'm going to go through some x-rays here of some funds in a minute, but you'll see how those allocations are changed from just a plain old, again, S&P 500 fund. But what I would really point your attention to here down below is where we see most of our growth rates. Again, very few amount of assets. So even though we've had significant growth in the last couple of years, still in the grand scheme of things, these are still pretty small, but still experiencing significant growth. Sustainably themed investing, and then positive or best in class screening. Sustainably themed would be completely investing in solar or wind. That's its own theme. Positive or best in class might be saying, I'm going to invest in energy, and then I'll let you decide what is most ESG friendly, whether that's solar or wind or something else. So again, hopefully, again, more perspective here as far as how broad ESG investing can get. And what has been good to see, and maybe you've read some articles about this over the last year, is that the idea behind investing sustainably, again, maybe 5 or 10 years ago, I would have told you that you might have to sacrifice performance within your account in order to take these sort of initiatives. And the biggest reason I would have said something like that is because of the fee basis. There were literally mutual funds out there where maybe you could buy the S&P 500 for 30 basis points or 0.3%, but the mutual fund that was catering toward this space might charge 1% or 1.2%. So you really need to have outperformance of almost 1% just by being in the ESG fund. But this chart is actually showing from JP Morgan a MSCI KLD 400 social growth index compared to the S&P 500. This is, again, social stocks compared to the S&P 500, performing relatively the same, and actually in some cases outperforming their regular indexes. Now down below you can see 10.7 versus 10.3%. This is over the last 40 years. 7.5 for EFA, which is outside of the United States, 6.9, and then this is an all-country world index, 5.5 versus 4.8. Now, very important to talk about here that past performance is no guarantee of future results. I'm sure you've seen that phrase before. And we'll talk a little bit about why that might not be the case moving forward. I wouldn't go into ESG investing necessarily thinking that you're going to outperform the market, because some of the weightings that we've put into these funds are in categories that just have done well. Have done well. Some of these technology companies have done well. Whether they'll continue to do that well, especially with valuations where they're at today, is hard to say. But it is at least uplifting to be able to see that we should be within a very close figure to what our standard investments would get. And then just finally, I have a note here, Nuveen, which is a mutual fund company that definitely has had a focus on socially responsible investments here. So maybe a little bit of a conflict of interest for them to be doing these kinds of studies, but they do say that 85% of investors agree that they'll not only invest responsibly, they will invest responsibly if returns are equal or greater. So again, definitely demand here, and definitely why we're going through this presentation. So what I want to do is a couple of things, beyond what maybe you've kind of read in the news at a high level. I want to get pretty specific. I want to go through some of these funds and just show you what they are composed of. One thing I would really caution you if you were going to make these investments on your own is to just pick out mutual funds or ETFs that just have ESG in the name or socially responsible in the name. Because as you can imagine, whether it's iShares like I have on the screen or any other fund company, they make money by you putting money into their funds, right? They're charging some sort of expense for you to be there. And so some are going to be more responsible and more active than others. Others are just, again, marketing and not really paying a whole lot of attention to it. But for this purpose, I'm at least comparing 3 indexes here that are all very low cost, really plain vanilla, and just trying to give you some perspective on even how these look a little bit different. So 3 indexes that I'm comparing here: iShares, the ESG MSCI USA Leaders, and then SPY, which is just an index that follows the S&P 500, and then SPYX, which is the Spider S&P 500 excluding fossil fuel companies. So these 3 will be a little bit different, as we'll see, but over the last 1 year, performance has been generally about the same. 14.78 for SUSL, 15.03 for SPY, and then 16.02 for SPYX. So again, kind of staying with the same theme here, that generally some of these funds are actually performing almost exactly the same, and then that's despite what their underlying holdings might be. So again, trying to compare these as best as possible because they all are using the large blend as their index that they're kind of weighting themselves to. So this is SPY, their top holdings. This comes from Morningstar. And you'll see here that, again, Apple, Microsoft, Amazon, Facebook, Tesla, Alphabet, which is the parent company for Google, and Berkshire Hathaway. No surprise here, you've all heard of these names before, and these are the largest weightings in the S&P 500, okay? But as we continue along here, now we're going to look at SPYX. Again, this is the fund that's going to exclude those large oil companies. And the weightings are relatively similar, but two big points to keep in mind, or one big point to keep in mind here, is that there is no Tesla at all here. Otherwise, if we kind of go back and forth, if you can bear with me, you can see Apple is at 6.99% in this fund, and the other fund at 6.83. Microsoft 5.81, 5.63. So SPYX, because it's just excluding a couple of companies, they're not really taking a whole active approach to say that they want a higher percentage in either of these. This is an exclusionary sort of ETF. But as we get to our third ETF, things certainly change. This is S2SL. This is the iShares ESG MSCI USA Leaders Index. The big difference here is Microsoft. So again, before, I think we were at what, 6.99%. This fund is actually putting 10.5% into Microsoft. So that's actually a really significant overweight into that firm. And then you can see Tesla is number 2 on their list. And then NVIDIA, which wasn't on our list at all, they are a chip maker, gaming computers, processors, things like that. That's sort of their business. They definitely were not in the top S&P 500 funds that we were looking at before, but they've got a 2% weighting here. So some definitely big differences to some funds that we just saw from a performance perspective was actually relatively similar, at least over the last 1 year. Their underlying holdings otherwise might be a little bit different. Okay. So, that gives you some perspective on those kinds of funds. So how in the world do we even start by evaluating this? And I would say that when most of my clients come to me, they're not getting super specific like we will a little bit later in this presentation. They, again, just want to have that high level idea that I want to be just a little bit more sustainable. My clients, in a lot of cases, they're still looking at their assets like I might need to use these in retirement. So they don't want to take too many risks. They don't want to bet on solar, for example. They just want to take one step forward to be socially responsible. So one interesting way of looking at it, and this is Morningstar's way of rating the mutual funds and ETFs that they look at, is using Sustainalytics company level ESG risk rating. Okay, and you can read this paragraph as I talk along here, but they want to evaluate these funds based on risk-driven issues, but from ESG. So to be considered material to the risk rating, an ESG issue must have potentially substantial impact on the economic value of a company and therefore a risk-return profile of an investment company. So I find this kind of interesting. So at a high level, let's kind of talk about what that means. They're not necessarily saying that we're going to give a 5-star rating to the solar fund, for example, because we think this is the way things should go. They're actually looking at this more of just a risk to the business. So a low rating might be a company, let's just, to give it a real example, if there was an oil company out there that just only had oil rigs and they had made no investments whatsoever into, solar or wind or whatnot, like we've seen news articles about ExxonMobil and Chevron trying to do these kinds of things, but other oil companies that maybe haven't done this at all, they would have a lot of risk since things have been trending toward the absence of oil. To have no exposure to other kinds of renewable energies would definitely present a risk to them. I was reading more about Morningstar's sustainability ratings as I was creating this presentation, and it's not just environmental risks, but social risks as well. And as I read what they considered a social risk, I thought about Uber for a little while, because Uber a couple of years ago had a big issue with the diversity of their hires. They definitely didn't have many women on their board, for an example. And the way Morningstar talked about their social evaluation was not only like what is the diversity of the company, but what are the switching costs from a customer's perspective. And I thought about Uber because Uber has a very low switching cost. Like you can pull up your phone, you can open up your app, and you could use Uber or Lyft. It doesn't really make a difference which one you use. There's not a really high switching cost there. And so if they still had those issues, which I don't follow Uber that closely, but if they still had those issues, Morningstar might look at them as having very high risk, low switching costs, and very low diversity. So if you're interested in that, you can go read more about Morningstar's ratings, but it might at least give you a starting point as you're looking at mutual funds to say, what might I consider based on what Morningstar is saying, for future investment prospects based on ESG categories. Okay. And I like the way they do it too. It's not like they're just handing out a disproportionate amount of 5-star and 4-star ratings. They have all their funds listed, and they have to have a certain percentage in the 5-star category, 22.5% in the 4-star category, et cetera. Or I should say the 4 globe category in this case. So let's just compare the funds that we've been looking at so far. SPY, again, our standard S&P 500 index fund. This is how that page looks when we look up their sustainability score. They've got 3 globes, and we can see here that they're in the 46th percentile, which is what we would expect, pretty close to the 50th percentile. These ratings right here, if you want to follow along, mean the lower score, the better from Morningstar. So the lower we get to 0, the better off that they are performing from an environmental, social, or governance standpoint. Okay, so let's go ahead and just compare this very quickly to SPYX. SPYX, again, this is the fossil fuel of eliminating those oil companies. Now we see that this fund is falling into the 35th percentile, still in the 3 globe category, and not a whole lot of difference. In fact, the social score and the governance score are almost exactly the same, but it's the environmental score that got a little bit better. So it's 3.58 for SPYX, whereas it was 3.82 for SPY. So just a little bit of a tilt as we go over to SPYX, but as we continue along here and we look at SUSL, now we've got a 5 globe fund. This is in the 6th percentile. And now our environmental score has gone down, our social score and our governance score has also gone down. So, if you're evaluating these 3 as part of your large blend portfolio, you might want to be taking a pretty hard look at SUSL. Again, as long as you also were okay with the underlying holdings that I showed you earlier, where again, they're overweighting Microsoft, overweighting Tesla, putting NVIDIA in there for a 2% holding, that might be where you want to go. Probably has a higher standard deviation than those other funds, meaning it's going to go up and down a little bit more. But again, as we saw over the last year, the performance is relatively the same. Okay. So again, I've given you some perspective there, and I've just been talking about basically large cap funds. But what I want to make sure I acknowledge at this point in the presentation is that a portfolio really needs to be constructed with several different asset categories. So I threw up this slide. I know there's a lot of numbers on here, but I just wanted to throw it up for perspective purposes, because when I'm creating a portfolio and I'm thinking about, whether you're 30 years old or 50 years old or 70 years old, we're trying to find a target risk, which would then allocate how much we might have in stocks versus bonds. But it's more complicated than that, because even within the stock category, you've got United States stocks versus international stocks. And then within the US category, we usually break these down into large size companies, mid-sized companies, small size companies. And then within that, we've got companies like growth stocks. These are your technology stocks, and your value stocks. These might be, again, your Coca-Cola, your Procter & Gamble, things of that nature. So I want to acknowledge that, because when you're thinking about ESG investing, it's very easy to find ETFs and mutual funds that specialize in the large cap United States space. We have a lot of information on these kinds of companies. They've been around for a long time. A lot of requirements here in the United States for how they file their financials. And so as such, when you compare the expense ratios of these funds, they're going to be pretty low. As you start to get into other categories, mid-sized companies, small-sized companies, international, large international is an okay space, but as you get into like emerging markets, for example, again, much harder to evaluate that in general, but then even more hard to evaluate that from an ESG perspective, because you've got not just the companies underlying, what they do, but how about the country and their political environment, and whether they're going to be able to, survive an environment where they're at. So as you create your own portfolio, if you're doing this on your own, or if you have an advisor who's creating this, you just want to be careful about just completely making your portfolio ESG friendly, and making sure that if you are going to do that, that you make sure you also put funds into each of these categories to make sure you're capturing the whole market, because the S&P 500 is not the whole market. It's just the 500 largest stocks in the United States. There's thousands of mid-sized companies, thousands of small companies. We've got real estate investment trusts on here. We've got, again, obviously emerging markets, other internationals, and then bonds, which we're not going to talk about today. But there are also ESG bond funds out there that you want to incorporate to your portfolio as well. So as I acknowledge that, let's just talk a little bit about ESG risks as we get into the broader areas of sectors. Because again, maybe as obvious as I say this out loud, but there's going to be more of an ESG risk in, say, the energy side of things. So energy, again, most commonly a consumer is going to want to avoid those oil companies. So a lot more of those energy companies are going to have higher risk scores. Utilities, basic materials, same idea here. Whereas things that are going to have low ESG risk scores are going to be in real estate, technology, and consumer cyclicals. So I mentioned earlier that we want to be careful about looking about past performance, because past performance shows us that the ESG funds have actually in some ways outperformed their peers. But if you think about the last 20 or 40 years, what has done really well? Well, real estate and technology have done really well. Everybody knows that. Again, when you look at the largest companies in the United States, many of them are technology companies. Your Facebook, your Google, your Microsoft, your Amazon, they lie right here. Real estate has done really well with low interest rates. So as you kind of target this, whether those will do just as well for the next 20 years is hard to say, but you'll definitely be more overweight into these kinds of sectors by making the choice to go to an ESG weighted portfolio. Along those same lines, there are also different countries that are a little bit more, let's just say, ESG friendly than others. And again, no surprise here, the ones with the lowest ESG risk scores, according to Morningstar, are in Europe. And obviously, we have our Paris Climate Accord that was signed a few years ago, and the United States is now getting back into. I think, again, very common for people to know that European countries are very forward-thinking with these sort of topics. Other developed Europe and then developed America is a little bit better in this category. Whereas when we get into like emerging Europe, this is going to be Russia, a lot of Eastern Europe countries. Emerging Americas, this is like your Latin America, Middle East and Africa, and then emerging Asia. They're going to be on this side of the spectrum as far as ESG risk scores, a little bit higher risk. So, again, who knows what will happen moving forward, but if you're going to have an ESG weighted portfolio, you're going to have more of your investments here. Whereas, again, don't know what will happen moving forward, but if these countries do well, you would end up underperforming over time. So we just want to make sure we acknowledge that as we are constructing a portfolio here. Okay. So as I kind of start to get wrapped up in our presentation and give you a little bit more specific recommendations, we've talked about some broad funds, and I've got a lot of fund companies that I use. Parnassus comes to mind, Calvert comes to mind, that I use that have been around for a long time and now, again, are getting a lot of inflows in funds. They've been doing this for a long time, and I'm confident that they're not just adding it on or tacking it onto their menu as a marketing strategy. Like, this is their bread and butter. There's a lot of good funds out there if you want to sort of, again, just be a little bit more particular with your mid-cap blend or your small-cap value fund that you're using in your portfolio. But if you want to take it a step further and get even more specific, I just did a little research to kind of see what could you actually find and just maybe how broad these are. These are not recommendations, and I don't. Maybe I've used one or two of these in my clients' portfolios when they've asked for it, but I just wanted to show it to you because I think it's interesting to see how specific we can get. So NACP, this is an Impact Shares Minority Empowerment Fund. So a lot of talk, especially over the last couple of years, about hiring minorities. Their top holdings are Apple, Microsoft, and Amazon. And I included the expense ratios over here because, again, 5 years ago, these would have been all over 1%, but these are very reasonable, 0.49%. Now, again, that's more expensive than what you would get for like an S&P 500 fund, which is going to be 0.02%. So you're definitely paying to have this, but you have the option if you want to have a little bit more tilt to those companies. Ticker symbol SHE. This is the SPDR SGA Gender Diversity Fund. Now we've got PayPal, Texas Instruments, Johnson & Johnson, and Disney as our top holdings. And this is actually a pretty reasonable expense ratio, 0.2%. So, we never saw PayPal, for example, on our funds that we were looking at before in the top holdings, but it's their top holding. So if you want to be more catered toward gender diversity, SHE is your ETF. TAN, this is Invesco's solar fund. So these companies mostly are not going to be familiar to most people. Enphase Energy, Solar Edge Tech, and Sunrun. Again, you got a higher expense ratio here. But generally, because a lot of things change with regulations, and especially now that we have a Biden administration, these solar companies might actually do well, but it's always hard to pick out in this category which of the companies are going to do well. So before going and just investing in Enphase or Solar Edge or Sunrun, this is a really good example where ETFs are, serve its purpose to give you diversification across an entire sector. Same thing with wind energy, FAN, again, 0.62, so a little bit elevated there. BOTZ, this is a robotics and artificial intelligence fund. And then finally, PJP, this is the dynamic pharmaceuticals fund, which again, I really hadn't thought too much about, but is definitely one of the categories we talked about earlier as far as progressive medicine and better care for patients. So those are just 6 examples that I wanted to find very quickly and to just bring to your attention. There are many more and more coming by the day as more money and more consumers are demanding this. You can get just as specialized as you want to be. So as we conclude our presentation here, just want to make sure I talk a little bit about what exactly is my impact. Should I be doing this at all, or maybe I should wait? Well, I would just make sure I acknowledge first and foremost that the best way that you're going to support any cause that you have in mind, as I've talked about this today, is to actually go out and purchase a company's goods or services. If you have a demand for, again, just to get to the really general examples, if you want solar or renewable energies to go well, you're much better off putting solar panels on your roof than actually buying this ETF. Because when you buy the ETF, you're still a very, very small owner in these companies. If you own them individually, you'll be able to cast your vote. And as their share prices increase, it is true that if they decide to sell more shares in the future, they're going to have more funds to their disposal to be able to reinvest in their own company. So I don't want to say that it's not important at all. I think it is. And obviously these kinds of things depend on your stage of life. So if you're 30 years old and you haven't even bought a house yet, and you're trying to figure out, a down payment for that house, maybe the best way for you to make an impact is to hold these kinds of investments, especially in a retirement account that you're not going to need for 30 years. Maybe it's a little bit more risky, but you can kind of steer your retirement accounts in that direction because you don't even have a house to put solar panels on yet. But when you're 65 or 70, and after maybe you've created a financial plan with your financial advisor, and you've come to the conclusion that you are going to donate assets, maybe you are going to give some away to your children, and for the assets that you're holding on, maybe a portion of those should be categorized in some way, shape, or form, maybe very specific into the causes that you care about. I think it makes a lot of sense for those kinds of people to have that. And I have clients who have completely turned over their portfolio to be completely ESG related in some way, shape, or form. And you have that option now here in 2021 with all the different funds that have popped up over the years. So just want to make sure I acknowledge that. And then one last thing I'll just bring to your attention, because I mentioned earlier that we have 2 sides to our practice where we manage wealth management funds and 401k plans. And there's a little bit of a difference here with 401k plans. So when somebody hires us to help manage their 401k, we are sharing a fiduciary responsibility with your employer. And your employer also has to act as a fiduciary, meaning that they have to evaluate investments to help people get to retirement. So, in the last 3 or 4 years, there have been employees who have asked for these kinds of ESG funds to be added to the menu. And you could try to do that, but just recently here in January, a couple of weeks ago, the Department of Labor came out and basically discouraged ESG investments from retirement plans under the ERISA plan. They want fiduciaries to evaluate investments on pecuniary factors such as risk, return, appropriateness, and fees. So by putting in an ESG fund from the Department of Labor's view, you're not really looking at it as if it's going to outperform one over the other. Most people are looking at it as having the same performance, but more fit with their sort of beliefs or morals. But the Department of Labor doesn't want you to do that. They don't want us to do that as a fiduciary. They don't want your employer to do that as a fiduciary. So prospectively, this could limit ESG investments in employer-sponsored retirement plans. So if you have those in your plan right now, it's very probable that they will stay there. But moving forward, they may no longer be added. So you may not have a whole lot of luck, and you might wonder why. Why won't they let us have a solar mutual fund? Well, this is why, because there's a lot of regulations on 401k plans. But this really helps you to then steer your attention to your IRAs, Roth IRAs, and your brokerage accounts. Those are completely up to your discretion. There's no ERISA plan that's going to prevent you from making investments there if you think those are the best fit for your portfolio. So you'd probably want to steer your investments there and be as specific as you would like to be. Okay, so I just want to make sure I acknowledge that. And I hope in our presentation today, again, I've at least exposed you to just how broad this is. And you can take this as far as you want. Some clients of mine just want to have a little bit of a tilt. Some we have 3 or 4 conversations and go through the specific mutual funds and their underlying holdings, like I've shown you today, to see if they fit with what their causes are. And that's a lot of fun. It's a really fruitful experience for us to really talk about what to do with your money. Not just in this case, but I spent a lot of time setting up like donor advised funds where my clients are going to donate to charity, and they get a tax break for doing so, which I'm happy to talk about if you have more interest on that. I have done presentations on that in the past, but this is, again, just another way for you to be a little bit more proactive for your causes. So in closing, fncadvisor.com is our website, First National Corporation. A lot of good resources here, and I'd encourage you to check out our blog where we try to put up current topics for you to consider. If you happen to be a dentist in this presentation, I have written an ebook that you can go and sign up for. You just go to fncadvisor.com/dentist, and you'll be able to just put your email in, and you'll get a PDF and a Kindle version of that ebook, which about 80% is relevant for just about anybody. This middle section right here, or selling your practice, is obviously dentist specific. But even if you're not a dentist, feel free to sign up, and I think you might learn something as you go through all these different categories and get my perspective on that, having managed many clients and worked with many assets. So in closing, fncadvisor.com/blog, again, where I put a lot of my thoughts, my LinkedIn, my email, and our phone number. Feel free to reach out. I'll hang around here on the conference for a minute or so in case anybody has any questions. Otherwise, thank you again for joining our boot camp, and hope to see you next month in our next presentation.